Okay, now the next thing we're going to cover is we're going to do some, since we just did one that was held for sale, so that didn't meet the criteria for a discontinued operation, let's just do one for held for use. Let's do a couple of them. Let's do multiple choice number 50 and 52. Okay, 50 and 52. 50 and 52 are found on page 247 and 248, so let's take a look at that. On page 247, number 50, which sort of like hangs over from 247 to 248, for number 50, the stem is, what is the amount of the impairment loss that would be reported on Bubba's income statement prepared for the year ended December 31st, 2008? So they want to know what's the amount of the impairment loss. Okay. Number 50 says, during December of 2008, the Bubba Company, don't you just love that, the Bubba Company? During December 2008, the Bubba Company determined that there had been a significant decrease in the market value of its equipment used in its manufacturing process. Okay, that's a decline in the fair market value of the item. That's one of our little bullet points at the top of the handout on the left-hand side. At December 31st, Bubba compiled the following information. The original cost of the equipment was $300,000. The accumulated depreciation was $300,000. That means the carrying value was $200,000. The expected net future cash inflows, undiscounted, related to continued use and then eventual disposal of the equipment was $175,000, and then the fair market value of the equipment is $125,000. They want to know what is the amount of the impairment loss that would be reported on Bubba's income statement prepared for the year ended December 31st, 2008. Okay, this is obviously going to be held for use. The reason is because we're going to continue to use it until it's all used up, and then we're going to dispose of it. So we already know that one of the bullet points appeared is that there was a decline in the fair market value of the asset. So then we have to, I'm on the far left-hand side of my handout under held for use. We're going to go ahead and test it for impairment. What we'll do is compare the carrying value. The carrying value is $500,000 minus the $300,000, the cost minus the accumulated depreciation, which gives me a carrying value of $200,000. I'm going to compare that with the non-discounted future cash flows. The non-discounted future cash flows are $175,000. So we just flunked the impairment test. You see how the $175,000 of non-discounted future cash flows can't even cover the carrying value of the $200,000. So now we have to measure the amount of the impairment loss. And the measuring the amount of the impairment loss is the difference between the carrying value and the fair market value. The carrying value is $200,000. The fair market value is given as $125,000. So $200,000 minus $125,000, we're going to have to write it down by $75,000. So the journal entry that you would make would be to debit the impairment loss by $75,000, credit the accumulated depreciation by $75,000. Okay. So they want to know what is the amount of the impairment loss that should be reported on Bubba's income statement prepared for the year ended December 31st, 2008. The correct answer is A, it's $75,000. Remember, you can choose A, but only if you're sure. Now let me tell you what else they could ask. Besides asking what is the amount of the impairment loss, which was a 75K credit, 75K. They could also ask you what's the ending balance and accumulated depreciation. So here's the accumulated depreciation. Before the impairment loss, the accumulated depreciation was $300,000. Then by crediting the accumulated depreciation by additional $75,000, by the way, that's called an adjusting journal entry. You'll credit it by $75K. So then what's the ending balance? The ending balance is going to be $375,000. So they can also ask you what is the ending balance in accumulated depreciation. And by the way, that answer is there. It is answer D, like David. So if they had asked you what is the ending balance in accumulated depreciation, the ending balance in accumulated depreciation would be $375,000. The answer would be D. Now they didn't ask you that. They asked you what is the impairment loss. By the way, where would the impairment loss of the $75,000 be shown? Where would this impairment loss be shown? Well, of course, the answer is it depends. If it's a publicly traded company, the impairment loss is shown with the other operating expenses, which is selling, G&A, R&D, and the organizational cost. Remember, that's on page 128 of your textbook on the multiple-step income statement. If it's not a publicly traded company, the impairment loss will be shown in minus other expenses and losses. So I told you the first question is, what is the amount of the impairment loss? The second question is, what is the ending balance and accumulated depreciation? The third question they could ask you is, what is the new carrying value of the asset? Well, the new carrying value of the asset is, remember that the historical cost of was $500. Then we'll subtract the ending balance and accumulated depreciation, which is a $375. So that the carrying value is now 125. Remember that we wrote it down to the fair market value. So the fair market value is the same thing now as the revised carrying value of 125. They could ask you what is the new carrying value of the asset after you recorded the impairment loss. That's 125. So they could ask you lots of things. So when you answer these questions, you have to answer the questions my way. Number 1, what is the amount of the impairment loss? Number 2, what is the ending balance in accumulated depreciation after the impairment loss is recorded? Number 3, what is the new carrying value of the asset after the impairment loss is recorded? Okay? All right, let's take a look at another one. Multiple choice number 52, please. Number 52. 52 is found on page 248. Number 52 says, assume that the long-lived asset is being held for use in the business and that the asset is depreciable. So it's held for use and the asset is depreciable. Number 52 on page 248 says, which of the following statements is or are correct about the carrying amount of a long-lived asset after the impairment loss has been recognized? Remember, recognized means you put it in a journal entry and it gets put on the financial statements. Assume the long-lived asset is being held for use in the business and that the asset is depreciable. If it's held for use, then it's the held for use column on my handout on page 7. Roman numeral 1, reduced carrying amount of the asset may be increased in subsequent years if the impairment loss has been recovered. False. Once you write it down again, you are not allowed to write it up again, even if it recovers. You cannot write it up again. The only time you can write something up again is if it's held for sale. Roman numeral 2, the reduced carrying amount of the asset represents the amount that should be depreciated over the asset's remaining useful life. Yes, you will continue to depreciate the asset. Look in the bottom left-hand block. You will continue to depreciate it, but of course the depreciation will be less because the carrying value is so much less. So the correct answer is Roman numeral 2 only. The correct answer then is B, like Barbara. Okay, B like Barbara. By the way, what would the answer be if I said assume this long-lived asset is being held for sale and the asset is going to be disposed of, and the asset is depreciable and will be disposed of as soon as possible? It's held for sale, the asset is depreciable, all right, but it's going to be disposed of as soon as possible, all right? Well, then the correct answer would be Roman numeral 1 only, and the correct answer would be A, because if it's held for sale, you're not supposed to depreciate it. And Roman numeral 2 would be false, but Roman numeral 1 would be true, because if something recovers, you are allowed to write it back up again if it's held for sale. So the correct answer is Roman numeral 2 only if it's held for use, but Roman numeral 1 only, answer A, if it's held for sale. So make sure you answer the question both ways. See that? But the correct answer for what they asked is B, like Barbara. Okay, now, before I go on, I just want to point out to you something on this handout. At the very, very handout, we have the little note. Let's take a look at the little note with the teeny-weeny print at the very bottom of the handout. The note says, I'm on page 7 of the handout, the note says, the handout has been updated for standard number 154, accounting changes and error corrections, a replacement of APB opinion number 20, and FASB statement of financial accounting standards number 3. Also, statement of financial accounting standards number 157, fair value measurements, which was originally effective for years beginning after November 15, 2007, but FASB preferred a 1-year deferral for the non-financial assets and the non-financial liabilities. SFAS number 157 changes how to measure the fair market value, meaning there's 3 ways to measure fair market value. They're level 1, level 2, level 3, and level 1, level 2, level 3 are roughly commensurate with the 3 techniques. That was the market method, which means a quoted price from an active market. The cost method, which is like something that you would pay as a replacement cost, like the Kelly Blue Book value. And then income method, or income technique, is where you use a present value of discounted cash flows technique, where it's non-observable inputs. Okay, so level 1, level 2, level 3. Okay, so standard number 157 changes how to measure the fair market value. And remember, level 1, which is the market method, takes precedence over level 2, which is the cost method, which takes precedence over level 3, which is the income method. But it doesn't tell you when to use it. One method for measuring the fair market value is the income technique, which is the present value of the future cash flows. But remember, that's level 3. That is the lowest level of the hierarchy. You want to use level 1 or level 2 if that information is available. I want to take a look at some multiple choice questions on that. First, there is some other information in the book that I wanted to point out to you on this, besides what was on my handout. Here it is. On page 237. On page 237, at the very, very top, like the 4th line down on page 247, it says, SFAS, I'm on page 237, about 4 lines down. The 4th line down says, SFAS number 157 provides guidelines for determining the fair value of the asset. The principal or most advantageous market for the asset should be used, consistent with the asset's highest and best use. An in-use valuation premise assumes the highest value of the asset is by using it in the business with other assets. In a standalone and in an exchange premise assumes that the highest value of the asset is the amount received to sell the asset standalone. So you have the in-use valuation and then you have the in-exchange valuation. What they're going to do is they're going to ask this. If they ask which level should you use, level 1, level 2, or level 3, where level 1 is the market method, which is a quoted active market method, or level 2, which is the cost method, which is like it's a replacement cost or very comparable to you, but not exactly the same, okay, as that asset. It's like a Kelley Blue Book value for the car. Then you have level 3, which is the income technique, where you take the present value of the future cash flows or a multiple of revenue or a multiple of net income, whatever. It's from unobservable inputs, okay? So level 1, level 2, level 3. If they give you level 1, level 2, level 3, you select the highest level. Now what happens if they give you 2 figures within the same level? Let's just say they have level 2. And in level 2, they have an in-use valuation. And then in level 2, they also have an in-exchange valuation. In use means the highest values when the asset is in use with other assets. In exchange means the highest values when the asset is for standalone. The answer is just pick the highest number, all right? So between level 1, level 2, level 3, pick the highest level, but within a level, they give you 2 values, in use and in exchange. Just pick whatever is the number that's the largest within the same level. Okay, let's take a look at multiple choice numbers 46, 47, and 48, please. 46. 47 and 48 are found on page 247. These are brand new. They're brand new for 2009. That's because the FASB did delay implementation of standard number 157 for periods until after November 15th, 2008 for non-financial assets and non-financial liabilities. So 2009 is the first time that this can appear. And if it can first start appearing in January of 2009, because you were allowed to elect early implementation. Okay, on page 247, we're going to do 46, 47, and 48. 46 says, what is the amount of the impairment loss that Lynx should report in its 2008 income statement? Okay, the Lynx Corporation acquired equipment on January 1st of 2007 for $100,000. The equipment has a 10-year useful life and no salvage value. On December 31st, the following information was obtained regarding the equipment. We have the expected value of undiscounted cash flows is $72,000. The fair value estimated with an in-use valuation premise is $74,000, and the fair value with in-exchange valuation premise is $70,000. So what is the amount of the impairment loss that Lynx should report in its 2008 income statement? Okay, so we're going to assume that this equipment is going to be held for use. So what's going to happen is you're going to have to perform the impairment test. When you perform the impairment test, you have to compare the carrying value with the non-discounted future cash flows. Okay, what is the carrying value of the asset? We first purchased the asset on January 1st of 2007 for $100,000. The equipment has a 10-year life and no salvage value. So we're going to have to calculate depreciation expense on this. So, using the straight line method. Cindy can't even write anymore. The straight line method. Okay, which is the historical cost minus the salvage value all over the useful life. The historical cost for this asset is going to be $100,000. The salvage value they gave was 0. The useful life is 10 years. That means you're going to have depreciation expense of $10,000 per year. Did they purchase this asset at the beginning of 2007? Yes, they acquired the asset on January 1st of 2007, so they can take a full year of depreciation in 2007, and of course a full year of depreciation in 2008. So then we would have accumulated depreciation. In 2007, we put in $10,000. In 2008, we put in $10,000. So the balance then at 12/31/2008 is going to be $20,000. So the historical cost is $100,000. The accumulated depreciation at December 31st, 2008 is $20,000. So my carrying value of the asset is $80,000. We'll then, in performing the impairment test, compare the carrying value versus the fair market value. So what's the fair market value? To perform the impairment test, we compare the carrying value versus the non-discounted future cash flows. Non-discounted future cash flows. So the non-discounted future cash flows in number 46 are expected value of undiscounted future cash flows of $72,000. In which case we see that we flunked the impairment test because the cash flows in the future cannot even cover the carrying value. So now we have to measure the amount of the impairment loss. And when we measure the amount of the impairment loss, we're going to have to measure the amount of the impairment loss, we compare the carrying value versus the fair market value. The carrying value versus the fair market value. We already know that the carrying value calculated is $80,000. So what's the fair market value? Well, here in the fair market value, they give you two measurements. The two measurements they give you is fair value estimated with an in-use valuation of $74,000, and they have the fair value estimated with in-exchange valuation of $70,000. So which fair market value do you choose? The answer is you choose the highest one, and the highest one here is the $74,000. So that means that the impairment loss is going to be the difference of $6,000, and your journal entry will be debit impairment loss, credit accumulated depreciation for $6,000. So, when they ask us, what is the amount of the impairment loss that Link should report in its 2000 income statement? The correct answer is $6,000. So, the correct answer then would be A. You can choose A, but you have to be sure. Remember, if it's within the same level, you choose the fair market value is the highest. Now, what are the other two questions that they could ask? They could ask you, number one, what is the amount of the impairment loss? The amount of the impairment loss is $6,000. Number two, what is the ending balance in accumulated depreciation? Well, this is then the $20,000 in the accumulated depreciation. Now, if we record the impairment loss, remember we credited impairment loss for $6,000. We debited impairment loss for $6,000. We credited accumulated depreciation for $6,000. So we'd add another $6,000 here. So that would be the balance after the impairment would be $26,000. And then the carrying value would be $100,000 minus the $26,000, which would be the $74,000, which would be the same thing as a fair market value. So they could ask us, number one, what is the amount of the impairment loss? The amount of the impairment loss is debit $6,000 to impairment loss, credit accumulated depreciation $6,000. Number two, what is the ending balance in accumulated depreciation after we record the impairment loss? That would be $26,000. Number three, what is the carrying value of the impaired asset? The carrying value of the impaired asset is now its new fair market value, which is $74,000. Let's take a look at another one. But they only wanted the amount of the impairment loss, which is $6,000. So the correct answer is A. You see these? These are getting harder because it never gets easier. Multiple choice number 47. Number 47 says, at what amount should the equipment be presented on the December 31st, 2008 balance sheet? So they want the carrying value of the asset. The Connor Company has equipment with a carrying value of $160,000 after recording the depreciation expense of 2008. The following information was available on December 31st, 2008. They have the value of similar equipment for sale in the market. That's level 2. It's like the cost method. Then they have the present value of the estimated future cash flows discounted at 10%. That's like the income method. That's level 3. Then they have the estimated undiscounted cash flows of the equipment. At what amount should the equipment be presented on December 31st, 2008? Okay. Once again, refer to your handout under held for use. We're going to have a test for impairment. The test for impairment. For the test for impairment, we're going to compare the carrying value versus the non-discounted future cash flows. Okay, here, that's nice. They at least give you the carrying value. The carrying value is $160,000. The non-discounted future cash flows. The estimated undiscounted cash flows of the equipment are $135,000. Okay, you can see that the future cash for this item will not even cover its carrying value. So we say this item is impaired. So now let's measure the amount of the impairment loss. So measure the impairment loss. when we measure the impairment loss, that's the difference between the carrying value versus the fair market value, where the carrying value is $160,000 and the fair market value is, now here they give us two levels. They give you the value of the similar equipment for sale, which is $140,000, which is the cost method, and then they have the present value of the estimated future cash flows, which is the income method. So which method are you going to choose? You're going to choose the highest level, which is going to be the $140,000 versus the fair market value of the $140,000. So once again, you compare the carrying value versus the fair market value at level 2, which is the value of similar equipment for the sale and market. So that's sort of like the Kelly Blue Book value. And so the amount of your impairment loss is going to be $20,000. Now, what did they ask us? They asked us, at what amount should the equipment be presented in the December 31st, 2008 balance sheet? Well, it's going to be at $20,000. Excuse me, it's going to record the impairment loss, debit the impairment loss for $20,000, credit the accumulated depreciation for $20,000. By crediting the accumulated depreciation for $20,000, the accumulated depreciation will go up and the carrying value of the asset will go down. And we'll write the asset down from $160 down to $140 because that will decrease the carrying value from $160, $140 by increasing the accumulated depreciation. So what's going to happen then is what amount should the equipment be presented on December 31st, 2008 balance sheet? That will be $140,000, which is level 2. So the correct answer there would be B, like Barbara. The other two questions they could ask are, number 1 was the amount of the impairment loss. The amount of the impairment loss is $20,000. We cannot calculate the ending balance and accumulated depreciation here because they never give us the beginning balance of accumulated depreciation, so we can't calculate it. But we can certainly calculate the new carrying value, which would be this. This minus the 20 gives you the 140. All right, number 48, the last one, says, what is the amount of the impairment loss that Dally must report in its 2008 income statement for the equipment? The Dally Corporation has equipment with a carrying value of $450,000. The following information was available on December 31st, 2008. The expected net cash flows undiscounted is $420,000. The expected net cash flows discounted at 7% is $400,000. Then they have that's like expected net cash flows discounted. Then they have fair value using the assets with other assets, $415,000. Then have fair value assuming the assets are sold in a standalone exchange. Okay, so what is the amount of the impairment loss that Dally must report in its 2008 income statement for this equipment? Okay, so let's first test it for impairment in number 48. The carrying value of the asset is $450,000, so we have $450,000 here. Then we have the non-discounted future cash flows for number 48. The expected net cash flows undiscounted is $420,000, so we have here $420,000. Uh-oh. You can see we flunked the impairment test because the future cash flows of $420,000 cannot even cover the carrying value, so we are impaired. So now we have to measure the amount of the impairment loss, where we calculate the $450,000. And we're going to compare that with the fair market value. Now, they give us a whole bunch of fair market values here. They say that they have the expected net cash flows discounted at 7%. Well, that's sort of like the income method, okay? Then they have the fair value using the assets with other assets is $415,000. And then they have the fair value assuming the assets are standalone. Well, you know what? I wouldn't ignore the $400,000, which is a level 3, because obviously the other two might be a higher level. Okay, so when they say the fair value using the assets with the other assets is $415,000, that's the in use, and the fair value assuming the assets are sold standalone, that's in exchange. Okay, so I would choose the $428,000 because it's the highest one. So then you would compare the fair market value of $428,000. Always pick the highest one within the same level. So you compare the carrying value of $450,000 versus the fair market value of $428,000. So that would mean that the impairment loss is going to be about $22,000. So let's answer the question. They want to know, what is the amount of the impairment loss that Dally must report in its 2008 income statement? The amount of the impairment loss would be $22,000. What would be the new carrying value of the asset? The new carrying value of the asset would be $428,000. The reason is because when you debit the impairment loss and you credit accumulated depreciation for the $22,000, you're going to increase the accumulated depreciation and thereby decrease the carrying value, and you write down the carrying value from the 450 down to the 428, so this becomes your new carrying value, which is 428. I can't calculate the ending balance and accumulated depreciation here because they don't give me the beginning balance accumulated depreciation. So the best answer for number 48 would be D, letter D, 22,000 for the amount of the impairment loss. Remember, where do you show the amount of the impairment loss? Well, of course, the answer is it depends. Assuming this is always held for use, if you're a publicly traded company, the impairment loss appears with the other operating expenses that I showed you on page 128 for your multiple-step income statement. That goes with the selling, the G&A, the R&D, and the organizational costs if you're a publicly traded company. If you're not a publicly traded company, and go and minus other expenses and losses. That's where you can report the impairment loss. Okay, those are 3 new multiple choice questions for 2009. You have to understand those, okay, because this is a new standard that will be effective for 2009, effective at the beginning of 2009, okay? All right, so you've got to know what's going on with these. All right, we already went over the fair value. Remember that? We already talked about that in Module 7D, but that, I'm going to tell you, in Module 7D, when we go over standard number 157 and then standard a little bit later, standard number 159, it's throughout the rest of this book, over and over and over again because they're new. Okay. All right. Let's continue on then. Let's take a look at page 237. We're going to talk about goodwill and other intangible assets on the bottom of page 237. On page 237, in the middle of the page, they talk a little bit about depletion. Instead of having depreciation on property, plant, and equipment, you have depletion on what they call natural resources or wasting assets. Just read over that depletion stuff there. You can skip the insurance stuff. On letter J at the bottom, page 237, let's just take a look at that. Letter J says goodwill and other intangible assets. You don't have to look at the outline for Standard 142. I'll show you that. The bottom, page 237, says intangible assets are non-physical assets. Intangible assets normally include only non-current intangibles. Examples of intangible assets include copyrights, leaseholds, organizational costs, trademarks, franchises, patents, and goodwill. So those are all examples of intangible assets. The intangibles can be categorized according to the following characteristics. On page 238, their identifiability. They could be separately identifiable or lacking specific identification. Goodwill lacks specific identification. Okay, their manner of acquisition, you get them one or in groups or through a business combination. The only way to get goodwill is through a business combination. You have to buy another company and overpay. That's the only way to get goodwill. Okay, the expected period of benefit. Sometimes they have an indefinite life, or sometimes they have a definite life. I will be talking to you about that, whether it's definite or indefinite. And separability. Are they saleable? Can you transfer them out? Or are they just inherent to your company? Okay. On acquisition of intangibles, it says that the purchased intangibles should be recorded at their cost. This represents the fair value of the intangible at the time of their acquisition. However, any internally developed intangibles are considered to be research and development expense. The only exception is the cost to register a patent. Okay, let's just say that you incur all this research and development expense and you find the cure for cancer. All the R&D that you conducted is considered to be R&D expense, even if it results in the cure for cancer. Once you find the cure for cancer, then you can patent that cure with the Patent and Trademark Office, okay? And then the only cost that you can capitalize for that patent would be the cost for registering the patent, cost to pay an engineer to do a patent search, all the legal fees and filing fees, etc. Also, you can capitalize any cost to successfully defend your patent. Somebody may infringe on your patent and copy it without your permission, in which case you'll sue them. If you sue them and you win, the cost for successful defense of your patent is capitalized to the patent. Now, of course, if you lose, that would be an impairment because everybody's copying your patent. You don't have a patent anymore, in which case you'd have to record an impairment and probably write the whole thing off. Okay, but the costs for successful defense of a patent are capitalized. Down at the bottom of page 238, they do talk about some impairments. What I will do is I will go over the impairments, but I want to show you that on my handout because I do a really good job on the handout. So let's take a look at the handout. And in the middle of page 7 of my handout, page 7 of the Financial Accounting and Reporting handout, we're going to take a look at these columns for intangible assets that exclude goodwill, standard number 142, goodwill and other intangible assets. Now, standard 142 does cover all intangible assets, except it has separate treatment for intangible assets, not goodwill, and then separate treatment for intangible assets, goodwill. So it's goodwill by itself, and then the intangible assets, not goodwill by itself. That's why there's 3 columns there. There's not goodwill, definite life, not goodwill, indefinite life, and then finally the big fat column over the far right-hand side, that is goodwill. Okay, so let's just take a look at some multiple choice problems on this. Why don't we take a look at, let me see if I find a really good multiple choice question for you. Let's take a look at the handout, and we'll take a look at definite life and then indefinite life, and then we'll do some multiple choice. If you look at the column that says definite life means you know the useful life. What you'll do is you will amortize this intangible asset, but just like the held for use assets, you'll test it each accounting period for impairment. And it's the same test, which is the carrying value compared to the non-discounted future cash flows. If the carrying value is in excess of the non-discounted future cash flows, the cash is not even enough to cover that carrying value. So we say that the item then is impaired, and we drop down. Then you'll measure the amount of the impairment loss. It's the same type of measurement where you compare the carrying value versus the fair market value. The fair market value, just like standard number 157, you can measure it 3 different ways. It's the market value approach, the market approach, the cost approach, or the income approach. So they'll calculate the fair market values the same way. Now, where does this loss go? If the fair market value is below the carrying value, where does this loss go? Well, the answer is it depends. If the intangible asset is part of a larger group of assets that's going to be gotten rid of, and it meets all 8 criteria through a discontinued operation, that would be reported as part of discontinued operations only if it meets all the 8 criteria. If it doesn't meet the 8 criteria, then it's put in income from continuing operations. And then drop down where it says definite life, the last block. You may continue to amortize it, but believe me, the amortization will be less because you wrote it down. And if you cannot write it up again if it recovers. The only thing that's a little bit different about this is the journal entry. Before, when we did held for use, it would be debit impairment loss, credit accumulated depreciation. You don't have depreciation on intangible assets. With a definite life, you have amortization. So the journal entry would be to debit impairment loss, credit accumulated amortization. Once again, it would be debit impairment loss, credit accumulated amortization. Okay, now that's only if you know the useful life. Now let's take a look if you don't know the useful life. In the next column it says indefinite life. If you have an indefinite life, that does not mean it has a life of forever. It just means you don't know the life. If you don't know the life, you can't amortize it because you don't know over how long. You don't know the life. So what you're going to do is you're just going to compare the carrying value versus the fair market value. Remember, the fair market value you're going to measure, however it is you measure it under the market, cost, or income techniques. Okay, if the fair market value is below the carrying value. If the fair market value is below the carrying value, then what happens is you have an impairment loss. You're going to have to write it down. The journal entry that you would make would be to debit the impairment loss, credit the asset. You cannot credit accumulated amortization because you're not amortizing because you don't know the life. So you would debit impairment loss. You would credit the intangible asset itself. Once again, this loss will go into D of IDE if it's a material discontinued item, meaning it meets all the criteria, all 8 criteria for a discontinued operation. If it doesn't meet the 8 criteria, then it goes to income from continuing operations. Remember, you don't amortize this because you don't know the life, and you are not allowed to write it up again if it recovers. Look, folks, I line these things up, definite life, indefinite life. I line them up just so you can say, okay, this is what's the same and this is what's different. So you memorize the definite life and just memorize what's different for the indefinite life. Remember, indefinite life does not mean infinite. It just means you don't know the life. Okay, let's take a look at a couple of multiple choice questions on this. Let's take a look at multiple choice question number 62, please. After we do number 62, we're going to do 61. So number 62 and then number 61. Number 62 and number 61 are found on page 249. Let's take a look at number 62 on page 249. 62 says, what amount should LAVA charge against income during 2008, assuming amortization is recorded at the end of each year? Okay. On January 2nd of 2005, the Lava Company purchased a patent for a new consumer product for $90,000. At the time of the purchase, the patent was valid for 15 years. However, the patent's useful life was estimated to be only 10 years due to the competitive nature of this product. On December 31st, 2008, the product was permanently withdrawn under a governmental order because of a potential health hazard in the product. Oh dear. They were selling this product for 3 years, and finally it's dangerous. It's probably like fatal. It took them 3 years to figure it out. What amount should Lava charge against income during 2008, assuming that the amortization is recorded at the end of each year? Okay, so they purchased the patent. The patent was for $90,000. At the time of the purchase, it was valid for 15 years. However, the useful life was estimated to be only 10 years due to this competitive nature. There's probably no salvage value for this thing because they plan on keeping it all the way to the end. So the way you would calculate the amortization expense is basically you just use a straight line method, and you would take the historical cost minus any salvage value. There usually is zero on an intangible asset. The historical cost here was $90,000. And you're going to divide that by the life, and the useful life, even though the legal life was 15 years, the useful life was only 10 years. So that means it was a depreciation expense, amortization expense of $9,000 per year. This was the amortization expense. Now make sure that they purchased this thing at the beginning of the year so you can take a full year's amortization in 2005. They did. They purchased it on January 2nd, 2005, so you can take a full year's amortization in the initial year that they purchased it. So here we have then the accumulated amortization. And we had this for 2005, 2006. Oh, my pen is about to choke here. Get a new pen. Push it against the wall so Cindy doesn't fall on the pen. Then, ooh, that's much better. Okay, 2007. So we had it then 9,000, 9,000, and then 9,000. Okay, and so far then it's 27,000. Okay, so then they tell us on December 31st, 2008, the product was permanently withdrawn from sale under the governmental order because of potential health hazard in the product. So before we record the depreciation, they want to know what amount should Lava charge against income during 2008, assuming the amortization is recorded at the end of the year. Don't even bother amortizing it because you're going to have to write this whole thing off because they permanently withdrew it from sale under a governmental order. Ooh, very bad. Anyway, what you're going to do, you have the historical costs minus the accumulated amortization. This is going to give you your carrying value. The historical cost is $90,000. You subtract the accumulated amortization as of the end of December 31st, 2007. That's $27,000. So the carrying value is $63,000. You don't even have to bother, amortizing anymore. You're just going to write the whole thing off. So you're going to write the whole thing off for the $63,000. Okay? And the journal entry that you would make is you would debit the impairment loss, and you would credit accumulated amortization for the $63,000. Now, what amount should Lava charge against income during 2008, assuming amortization is recorded at the end of the year? The answer would be $63,000, so the correct answer would be C. Now, what happens if instead I had actually recorded amortization expense for 2008? In which case, this would be 2008 here, would be another 9,000, so that would be 36,000. 36,000, okay. And then that would mean my accumulated amortization would be 36,000 here, and then my carrying value would be 54,000 here, in which case my impairment loss would be 54,000 and 54,000. You'd still have the exact same answer because they want to know what amount should Lava charge against income, assuming amortization is recorded at the end of each year. Well, you would have two parts of the income. One part would be the impairment loss, and the other part would be the amortization expense, in which case it would still be 9,000 and 54,000. It would still be 63,000, so it doesn't matter. Okay. Whether you record the amortization at the end of the year or you don't. You can just write the whole thing up. 63,000, so the best answer for that would be answer C. Okay, let's take a look at number 61. Number 61 says, over what period of time should Northern amortize the gate rights? The Northern Airline, I'm looking at number 61 on page 249. The Northern Airline purchased airline gate rights at Newark International Airport for $2 million with a legal life of 5 years. However, Northern has the ability and the right to extend the rights every 10 years for an indefinite period of time. Over what period of time should Northern amortize the gate rights? Should we amortize them over 5 years? That's their legal life. 15 years? 40 years? Okay, they have the right to extend the rights every 10 years. The answer is it should be indefinite. And the reason is because they probably have the intent to extend the rights every single time they're allowed to for an indefinite period, because Northern Airlines considered to be a going concern, right? So you assume a going concern, they're going to live forever, so they're going to need those rights, and they're going to extend them every single time that they are able to. So the best answer for number 61 is answer D, like David. The rights should not be amortized because the rights have an indefinite life. They have an indefinite life, not a definite life, because they probably have the ability and the right to extend them every single time. So the best answer is D, like David. The rights should not be amortized. They have an indefinite life. Okay, let's see if we can take a look at multiple choice number 64. Number 64 says, which of the following statements concerning patents is correct? Now let's just start with letter D for number 64. Letter D says, research and development costs incurred to develop a patented item should be capitalized and amortized over a straight line basis over 17 years. That's false. Research and development expenses are always going to be expensed, okay? How about letter C? Research and development contract services purchased from others and then used to develop a patented manufacturing process should be capitalized and amortized over the patent's economic life. That's going to be false. Research and development, whether you do it yourself or you contract it out, it's always treated as an expense. Letter B says, legal fees and other direct costs that are incurred in registering a patent should be capitalized and amortized on a straight line basis over 5 years. Well, this is halfway correct. You should capitalize the legal fees and other direct costs to register your patent, but you don't have to amortize them over the straight line method using 5 years. You amortize them using the straight line method using its useful life, whatever that life is, okay? Let's take a look at letter A. Letter A says the legal costs incurred to successfully defend an internally developed patent should be capitalized and amortized over the patent's remaining economic life. That's the best answer. The best answer for number 64 is A, because the cost for successful defense of a patent, you are supposed to capitalize that as long as you had a successful defense of it. However, if you sue and you lose, you expense the legal costs and you write off the entire patent, because obviously no one wants to uphold your patent rights and it's an impaired asset. All right, the last couple of things I want to talk about, I'm just going to talk about goodwill and then we're going to talk about R&D expense. If you take a look on the far right-hand column of my handout for page 7, it talks about circumstances that may indicate impairment has occurred. Okay, now this is for goodwill. The only way to get goodwill is to buy another company and to overpay. So if you buy another company and all its stuff, its net assets, which is the assets minus the liabilities, which are the net assets, let's just say it's $1 million, and you pay $1.3 million. The extra $300,000 that you pay over the fair market value of its net identifiable assets, that's going to be goodwill, because goodwill is defined as the excess of the acquisition costs over the fair market value of the net identifiable assets. The excess is the $300,000, which is the excess of the acquisition cost, which was $1.3 million, over the fair market value of the net identifiable assets, which was $1 million. So you pay $1.3 million over stuff that was only worth $1 million, so the $300,000 is the excess, which is goodwill. Now, goodwill can also be impaired, and you have to test it for impairment. And it's a two-step test, of which I will show you how to do that in a simulation. If you take a look at the circumstances on the far right at the top, circumstances that may indicate impairment has occurred. First of all, it's all the ones on the other list, right? So if there's a decline in demand, a net operating loss, a decline in fair market value, a negative cash flow, or adverse change in the legal or regulatory environment. It's never a good change, it's a bad change. Any one of those things on the other list. Other things, loss of key personnel. Yes, if your CEO resigns in disgrace, that's an example that maybe your goodwill is impaired. Also, if you had a subsidiary that recorded impairment loss, because somehow it just kind of like flows upwards. So if your subsidiary recorded impairment loss, that's another item. What there is there's a two-step test for impairment. The two-step test for impairment, let's take a look at step 1. First of all, you are not going to amortize goodwill. You do not amortize goodwill. And the two-step test for impairment is you're going to compare the carrying value of the reporting unit with the goodwill versus the fair market value of the reporting unit with the goodwill. So the carrying value of the reporting unit versus the fair market value of the reporting unit. So if the carrying value is higher than the fair market value, then that's an indication that you have to perform step 2. So it's a two-step test. So then it says the goodwill of the reporting unit maybe is impaired, so then you go to step 2. In step 2, you're going to compare the carrying value of the goodwill alone. So there's a balance sheet, and there's a line that says goodwill. So it's the carrying value of the goodwill alone, and you're going to compare that with the implied fair market value of the goodwill alone. Now the implied fair market value of the goodwill alone is the fair market value of the entire unit minus the fair market value of every single item on the balance sheet except for the goodwill. Then you compare the carrying value of the goodwill alone versus the implied fair market value of the goodwill that you just calculated as the fair market value of the entire unit minus the fair market value of all items except the goodwill. And then you're going to have to write that down. And that loss goes into income from continuing operations. Okay? And what's going to happen is that you're going to debit the impairment loss and you're going to credit the goodwill. Where does the impairment loss go? The impairment loss goes as part of income from continuing operations. If you're a publicly traded company, the impairment loss has got to go with the operating expenses, which is it goes along with selling, G&A, R&D, and organizational costs. If you're not a publicly traded company, then it goes into minus other expenses and losses. And the journal entry, once again, is to debit the impairment loss and credit the goodwill. You do not drop down to the bottom block. You do not amortize the goodwill. You never amortize it to begin with. However, and you cannot write it up again. Okay, you cannot write it up again. Let's just take a look at a simulation on this, okay? I did assign you simulation number 3. Simulation number 3 is found on page 257. I want to show you how they could test something like this. So please turn to page 257, and I'll show you how to apply the two-step test. Now, on page 257, where you only are responsible, I assign you all of simulation number 1. Simulation number 3, you only have to do the goodwill impairment. On page 257, at the top, this is the goodwill impairment. See how it's the bigger block? It says the broker corporation is performing its annual test of impairment of the goodwill related to its technology reporting unit. The carrying value of the goodwill allocated to the unit is $500,000. Using a multiple of revenue, broker has determined the fair value of the technology reporting unit to be $1.7 million at December 31st, 2008, and the fair value of the carrying value of the assets and liability are determined as follows. Is it possible that we can pause our little thing so I can write something on the board? I'm just going to pause it. Through the magic of technology, I'm going to write these numbers on the board, and I'll be right back. See, this is what they used to do on Bewitched. They used to stop the camera, and then Samantha would do her thing. Some of you are saying, what is Bewitched, Cindy? Well, they did a remake of it, didn't they? They did a remake with Nicole Kidman. I don't know who they did a remake of it anyway. Anyway, so through the magic of technology, I magically made all the numbers for simulation number 3 for the goodwill impairment appear on here. So what you're going to do then to perform step 1 and step 2, okay, they're performing their annual test, which of course you have to do, but of course you perform the impairment test anytime you have any of those bullets occur as well, but you have to perform it at least once a year. Okay, so remember, you do not amortize the goodwill. Let's look at the far right-hand column of my handout for page 7. You compare the carrying value of the reporting unit with the goodwill with the fair market value of the reporting unit with the goodwill. Okay, they said that the carrying value of the reporting unit with the goodwill, the carrying value of the reporting unit with the goodwill is $1,900,000. It's $1,900,000. They added that all nicely up for you. Then they gave you the information. They said that broker has determined that the fair value of the technology reporting unit is $1.7 million. Now, there's many ways to do that. You can do that through a multiple of earnings approach. You can do it with a market capitalization approach, which is you just take the number of outstanding shares times the market value per share. Okay, or you could have somebody do an appraisal for you. There's lots of ways to come up with that fair market value. But see, they will give you the fair market value on the exam. So it's $1.7 million. So once again, in step 1, you're going to compare the carrying value of the reporting unit, which is basically what's on its balance sheet, which is a $1,900,000. Remember, this is in thousands. So it's 1,900,000 versus a fair market value. Now this was given. Now because the carrying value exceeds the fair market value of the reporting unit, then you could see then that we have to perform step 2. We may be impaired. So in step number 2, you compare the carrying value of the goodwill alone. And remember that the carrying value of the goodwill alone was given. It was 500,000. That's the carrying value, so how it appears on the balance sheet. So the carrying value of the goodwill alone of 500,000, and you compare it with the implied fair market value of the goodwill alone. Now the implied fair market value of the goodwill alone is the fair market value of the entire unit. So they already gave us the fair market value of the entire unit. It was 1,700,000. You subtract the fair market value of everything else except the goodwill. Now I totaled up all these, and this came up to 1,500,000. I totaled all these up. You know, the goodwill is unknown. That's the fair market value. That's what we're trying to do. So you take the fair market value of the entire unit minus the fair market value of everything there, okay, except for that goodwill, and that's 1,500,000. So that means that the implied fair market value of the goodwill alone is 200,000. So you take 500,000, which is greater than the 200,000. So then you can see that the goodwill is impaired by a total of 300,000, which is the difference, okay? So when they ask you, in item number 1 on page 257, to calculate the following amounts related to the impairment of goodwill, the implied goodwill, which is a 1.7 million minus a 1.5 million, is 200,000, and the amount of the goodwill impairment would be 300,000, because that's the difference between its carrying value and the implied amount of 200, which you just calculated. So the amount of the impairment loss would be 300,000, and they want the journal entry, and the journal entry would be to debit the impairment loss and credit the goodwill for 300,000. Hands down, you've got to know how to do this calculations. Okay, you've got to be able to do step number 1, and you've got to be able to do step number 2. There's one final thing really in here, and that would be if you turn to page 239. On page 239, at the bottom of page 239, reporting the cost of startup activities, it says SOP 98-5. I'm on page 239 in the textbook. Provides guidance on financial reporting of startup costs, including organizational costs. Just remember that organizational costs will be expenses incurred. Organizational costs are part of the operating expenses. So it's like selling, R&D, G&A, organizational costs, impairment loss for SEC registrants. They're all put together as the operating expenses on your multiple step income statement on page 128. The last thing is going to be on page 240. I have research and development expense. I just want to point out to you some things that are always R&D and point out to you some things that are never R&D, okay? Okay. Always R&D. Anything to deal with new knowledge, new technology, anything to deal with a model or a prototype, or if they talk about reformulation of a process, things that are never R&D, include anything having to do with commercial activity or commercial production. Also, thing that's never R&D is anything that's routine or seasonal. Routine means they do it every month, they do it every quarter. Seasonal means they do it every spring, they do it every fall, that type of thing. So always R&D, never R&D. One other kind of picky thing about research and development expense is that if you have a machine, if you buy the machine and you're only going to use it on one research and development project, just one project, the entire cost of the machine is treated as an R&D expense. But if you buy the machine and you use it on many R&D projects and use it for lots and lots of R&D projects, then what happens is that you capitalize the cost of the machine, and then the depreciation expense on the machine becomes R&D expense. So buy a machine for only one R&D project, expense the entire machine as R&D. Buy a machine for multiple R&D projects, then what you can do is capitalize the machine and the depreciation expense becomes R&D expense. All right, there's just one multiple choice question I want to do with you, and that's on multiple choice number 72. Number 72 is found on page 250. Number 72 on page 250 says, in its 2008 income statement, Cody should report R&D expense of how much? The Cody Company incurred the following costs during 2008. design of tools, jigs, molds, and dies involving new technology. Okay, that's R&D. Modification of the formulation of a process. Okay, that's R&D. Troubleshooting in connection with breakdowns during commercial production. That is not R&D. Adaptation of an existing capability to a particular customer's need as part of continuing commercial activity. That is not R&D. So in its 2008 income statement, Cody should report research and development expense, probably just the 125 and the 160. So the total is 125 and 160. It's 285. So the best answer there would be D, like David. I did assign one other multiple choice question for the R&D, so I want you to do those ones too. The last thing I have for you is just the software. Software is found in your handout on page 8 of your handout. I don't want to waste time in our program to go over this, but I do want to point out to you this handout. I do think I told you this at the very beginning of Module 9. On page 8 of your handout, I just want you to take a look at standard number 86 on the left-hand side. I want you to do multiple choice questions number 77 and 78. And on the right-hand side, SOP 98-1, I just want you to take a look at the handout on the right side and take a look at multiple choice number 82. Okay? So just read the handout, read over it, and do those couple of multiple choice. I think that you'll be able to figure it out by looking at that. Okay? Occasionally, one question on software may show up. They're more likely to test what's on the left-hand side because that's a standard, as opposed to over on the right-hand side, that's just an SOP, an AICPA statement of position. And we already learned in the gap hierarchy under standard number 162 that statements of financial accounting standards are higher on the hierarchy than a statement of position written by the AICPA. So they're more likely to test the stuff on the left-hand side than the right-hand side. But take a look at it, since one multiple choice might come up, okay? And I'll see you then when I do Module 10 and the next disc, all right? Bye-bye.